There's a financial empire hiding in plain sight, not on the front pages, not in textbooks, right now operating in secrecy, controlling more wealth than most nations combined, and almost nobody understands how it really works. This empire doesn't need armies. It doesn't need flags. It doesn't announce itself on cable news. But it shapes your financial reality every single day, because this empire controls something far more valuable than gold or oil. It controls the machinery of American wealth itself, the system that decides who gets rich, who stays poor, and who holds power when everything collapses. This is the story of the most powerful financial network you've been trained to ignore. An empire built on leverage, secrecy, and manipulation that has controlled the American economy for over a century. And the reason you don't know about it is simple. If you understood how much power they actually have, if you saw what they've done with it, you'd realize that your savings, your retirement, your entire economic future has been engineered by a network that answers to no one, follows no rules, and operates in absolute secrecy. This is the story of the hidden Wall Street empire. And once you see it, you'll never look at money the same way again. Let's start with a building. Lower Manhattan, 23 Wall Street. A 5-story building that looks modest compared to the glass towers around it. But for decades, this building was the most powerful address in America. It was the headquarters of J.P. Morgan and Company, the bank that effectively controlled the U.S. financial system before the Federal Reserve even existed. You could walk past it 1,000 times and never realize that more power was concentrated in those 5 floors than in the White House, the Treasury, and Congress combined. Because inside that building was a network that didn't just manage money. It managed the flow of capital that built railroads, financed wars, bailed out governments, and decided which industries lived and which died. And at the center of everything they did was control. Not control of gold, not control of oil, control of credit, control of leverage, control of who gets access to capital and who doesn't. And they've been doing this since the 1800s, operating in the shadows, beyond the reach of democratic oversight, building an empire that survives every crisis because they designed the crises themselves. The empire was born in the late 19th century when J.P. Morgan and a handful of other bankers realized something the public never understood. You don't need to own the factories. You don't need to own the railroads. You don't even need to own the gold. You just need to control the flow of capital. Because whoever controls credit controls everything. In the 1890s, the U.S. government was on the verge of bankruptcy. The Treasury was running out of gold to back the dollar. And who saved it? Not Congress, not the president. J.P. Morgan. He organized a private syndicate of bankers who loaned the government $65 million in gold, preventing a collapse. But here's what they don't teach you in history class. That loan came with strings. Morgan's syndicate didn't just save the government. They gained control over it. They decided which bonds the Treasury could issue. They decided the interest rates. They decided who could buy them. The government became dependent on Wall Street, and that dependency never ended. It only grew deeper. This was the moment when the balance of power shifted permanently. The elected government was no longer sovereign over its own finances. A handful of private bankers in New York had become more powerful than the entire federal apparatus. And they knew it. Fast forward to 1907. A financial panic sweeps the country. Banks are failing. The stock market is collapsing. People are lining up outside banks, demanding their deposits. The entire system is on the verge of total collapse. And once again, it's not the government that steps in. It's J.P. Morgan. He locked the most powerful bankers in his library on Madison Avenue and refused to let them leave until they agreed to pool their resources and stop the panic. He forced them to pledge millions of dollars to shore up failing institutions. He personally decided which banks would survive and which would be allowed to fail. And it worked. Morgan single-handedly stabilized the financial system. But that moment revealed something terrifying. One man had more power over the American economy than the entire federal government. And the public started asking questions. Dangerous questions. If one man can save the system, doesn't that mean one man controls it? And if he controls it, who controls him? The answer was no one. Morgan answered to no government. He followed no laws. He operated in absolute secrecy. And the public hated it. Newspapers called him a dictator. Politicians demanded reform. The progressive movement called for government control over banking. So Congress did what Congress always does when the public gets angry. They created the illusion of reform. In 1913, they passed the Federal Reserve Act. The official story is that the Federal Reserve was created to prevent future panics, to stabilize the banking system, to protect the public. The story you read in textbooks is that it was a progressive reform designed to wrest control from the bankers and put it in the hands of the government. The unofficial story is that the Federal Reserve was created by Wall Street for Wall Street to make sure that the power Morgan had would never go away. It would just be institutionalized, legitimized, and hidden behind the facade of a government agency. The Federal Reserve Act was written in secret by bankers, not in Washington. On Jekyll Island, Georgia, at a private resort owned by J.P. Morgan's associates, the most powerful bankers in America met there in 1910 and drafted the legislation that would become the Federal Reserve Act. They wrote the law that would regulate themselves, and then they lobbied Congress to pass it. Here's how it really works. The Federal Reserve is not a government agency. It's a private cartel of banks. The 12 regional Federal Reserve banks are owned by the private banks in their districts, not by the government, not by the taxpayers, but by the banks themselves. And those banks elect the directors who run the system. So the banks regulate themselves. They set their own rules. They decide how much money to create. They decide interest rates. They decide which banks get bailouts and which banks fail. And they do all of this with zero accountability to voters, zero transparency, and zero oversight from anyone outside the system. The Federal Reserve is the ultimate Wall Street network, and it's been running the show for over a century. The chairman of the Federal Reserve is appointed by the president and confirmed by the Senate. But once appointed, the chairman is effectively untouchable. The Federal Reserve operates independently of Congress. It doesn't need congressional approval to create money. It doesn't need permission to bail out banks. It doesn't even have to fully disclose what it does. For decades, the Fed refused to be audited. When Congress finally forced a limited audit after the 2008 crisis, what they found was shocking. But we'll get to that. Now let's talk about leverage. Because leverage is the secret weapon Wall Street has used to build empires and destroy competitors. Leverage means borrowing money to amplify your bets. If you have $1 million and you borrow $9 million more, you can control $10 million worth of assets. If those assets go up 10%, you just made $1 million on a $1 million investment, a 100% return. But if they go down 10%, you're wiped out. You've lost everything. Wall Street loves leverage because when it works, the profits are massive. The returns are exponential. And when it fails, they don't pay the price. You do. The taxpayers do. The system absorbs the losses. In the 1920s, Wall Street banks were leveraged to insane levels. They were lending money to anyone who wanted to buy stocks. Ordinary people who had never invested before were borrowing to speculate in the market. Housewives, teachers, factory workers, everyone was in the stock market. The banks were borrowing to lend to the speculators. Brokerage firms were allowing people to buy stocks with only 10% down. The rest was borrowed. Everyone was betting with borrowed money, and it worked until it didn't. In 1929, the market collapsed. The leverage that had amplified the gains on the way up amplified the losses on the way down. When stocks started falling, the margin calls went out. People who had borrowed to buy stocks were forced to sell to cover their loans. That selling pushed prices lower, which triggered more margin calls, which forced more selling. It was a death spiral. Banks failed by the thousands. Over 9,000 banks collapsed during the Great Depression. Millions of people lost their life savings. The unemployment rate hit 25%. Families were starving. The economy collapsed into the worst depression in American history, and Wall Street walked away. The bankers didn't go to jail. They didn't lose their personal fortunes. The ones who had gotten out early kept their wealth. The ones who stayed too long restructured their firms, changed the names, and waited for the next opportunity. Because to them it was just a cycle. Boom and bust. Make money on the way up. Get bailed out on the way down. And the public always pays. After the Great Depression, Congress passed laws to rein in Wall Street. The Glass-Steagall Act of 1933 separated commercial banking from investment banking. Banks that took deposits from ordinary people were no longer allowed to gamble with that money in the stock market. If you wanted to be a commercial bank, taking deposits and making loans, you couldn't also be an investment bank, underwriting securities and trading stocks. It was a firewall designed to protect the public from Wall Street's recklessness, and it worked. For 60 years, the American banking system was stable. There were no major financial crises, no bank runs, no panics. Banks did what banks were supposed to do. They took deposits and made loans. They financed businesses and homeowners. It was boring, it was safe, and it worked. But Wall Street hated it. They hated being regulated. They hated being limited. They hated making steady, boring profits when they knew they could be making obscene, leveraged profits if the rules were different. So they spent decades lobbying, bribing, and manipulating Congress to tear down the rules. They funded think tanks that published papers arguing that regulation was inefficient. They funded politicians who promised deregulation. They put their own people in key positions in government. And slowly, year by year, they chipped away at the regulations. In the 1980s, they started winning. The savings and loan industry was deregulated. Small banks were allowed to make risky investments they had never been allowed to make before. And what happened? They made risky investments. They failed. Over 1,000 savings and loan institutions collapsed. The bailout cost taxpayers over $120 billion. It was one of the largest financial scandals in American history. And Wall Street learned a lesson, not the lesson you'd expect. They learned that they could take massive risks, fail spectacularly, and the government would bail them out. So they kept pushing, they kept lobbying, and in 1999 they finally succeeded. President Clinton signed the Gramm-Leach-Bliley Act, which repealed Glass-Steagall. The firewall was gone. Commercial banks and investment banks could merge. The same institution that held your checking account could now gamble with your money in the derivatives market. And Wall Street celebrated, because they knew what was coming. The biggest financial boom in history, and then the biggest bust. Within a decade, Wall Street had built the largest financial house of cards in history. They created a system so complex, so interconnected, so leveraged, that almost nobody understood it. Not the regulators, not the politicians, not even most of the bankers themselves. It was called the shadow banking system, and it operated entirely outside the rules that governed traditional banks. Shadow banks weren't technically banks. They were investment firms, hedge funds, private equity firms, special purpose vehicles. They didn't take deposits, so they weren't regulated like banks. But they performed all the same functions. They borrowed money, they made loans, they created credit, and they did it with almost no oversight. Here's how it worked. Wall Street took mortgages, thousands of them, and bundled them into securities called mortgage-backed securities. Then they sliced those securities into different risk tranches. The safest tranches got paid first, the riskiest tranches got paid last, but offered higher returns. Then they sold these securities to investors around the world. Pension funds bought them. Insurance companies bought them. Foreign banks bought them. Everyone wanted them because the ratings agencies, paid by Wall Street, gave them AAA ratings, the highest possible rating. Safer than U.S. Treasury bonds, they said. But it didn't stop there. Then they created derivatives on top of those securities, credit default swaps, collateralized debt obligations, synthetic CDOs, bets on whether the mortgages would be paid back, bets on the bets, layers upon layers of leverage. The same mortgage could be referenced in dozens of different derivative contracts. So if one mortgage defaulted, it could trigger losses across the entire system. And the whole system was built on a lie. The lie was that housing prices would never fall, that mortgages were safe investments, that the models predicting risk were accurate, that the ratings agencies were independent and honest. But Wall Street knew the truth. They knew the mortgages were garbage. They knew they were lending to people who couldn't afford to pay. They knew the models were fraudulent. They knew the system was doomed to collapse. And they kept selling anyway. Because the profits were too good. Because the bonuses were too big. Because they knew when it all collapsed, they wouldn't be the ones to pay. They'd sell the toxic assets to pension funds and insurance companies and foreign banks. And when those institutions failed, Wall Street would be long gone. They'd have their bonuses. They'd have their profits. And someone else would be holding the bag. In 2008, the house of cards collapsed. It started with subprime mortgages, the riskiest loans made to the least creditworthy borrowers. When housing prices stopped rising, those borrowers couldn't refinance. They started defaulting. The defaults triggered losses in the mortgage-backed securities. The securities were downgraded. The investors holding them tried to sell, but there were no buyers. The market froze. Then the panic spread. Bear Stearns, one of the largest investment banks on Wall Street, collapsed in March 2008. The Federal Reserve orchestrated a bailout, forcing J.P. Morgan to buy Bear Stearns for pennies on the dollar. Then, in September, Lehman Brothers, one of the oldest and most powerful banks on Wall Street, filed for bankruptcy. It was the largest bankruptcy in American history. $600 billion in assets gone overnight, and the entire global financial system seized up. Banks stopped lending to each other. Credit markets froze. The stock market crashed. Within weeks, Merrill Lynch was sold to Bank of America. AIG, the giant insurance company, was on the brink of collapse. Washington Mutual failed. Wachovia failed. The entire system was collapsing in real time. Treasury Secretary Hank Paulson, a former CEO of Goldman Sachs, went to Congress and told them that if they didn't approve a bailout immediately, the entire financial system would collapse within days. ATMs would stop working. Paychecks would bounce. The economy would go into a depression that would make the 1930s look mild. And what did the government do? They bailed out Wall Street. Not the homeowners who lost their homes. Not the workers who lost their jobs. Wall Street. The very banks that had caused the crisis were given trillions of dollars in bailouts, loans, and guarantees. Congress passed the Troubled Asset Relief Program, TARP, a $700 billion bailout for the banks. But that was just the beginning. The Federal Reserve created money out of thin air and handed it to the banks. They created special lending facilities. They bought toxic assets. They guaranteed trillions of dollars in bank debt. When you add it all up, the total bailout was over $16 trillion. That's more than the entire U.S. economy at the time. And the banks used that money to pay themselves bonuses. In 2009, while unemployment was at 10%, while millions of families were losing their homes, Wall Street paid itself $20 billion in bonuses. Not a single major Wall Street executive went to jail. Not one. They crashed the global economy, destroyed millions of lives, committed fraud on a scale never seen before, and walked away richer than before. Because the system isn't designed to hold them accountable, it's designed to protect them. Let's talk about the revolving door. Because the reason Wall Street never faces consequences is simple. Wall Street and the government are the same people. Look at who runs the Treasury Department. Hank Paulson, the Treasury Secretary during the 2008 crisis, was the CEO of Goldman Sachs. His successor, Tim Geithner, came from the New York Federal Reserve, which is controlled by Wall Street banks. The next Treasury Secretary, Jack Lew, had worked at Citigroup. Stephen Mnuchin, Trump's Treasury Secretary, was a Goldman Sachs banker and hedge fund manager. Janet Yellen, Biden's Treasury Secretary, was chair of the Federal Reserve. The head of the New York Federal Reserve, the most powerful position in the Federal Reserve System, is always a former Wall Street banker. The heads of the regulatory agencies, the SEC, the CFTC, the OCC, they're all former Wall Street executives. And when they leave government, where do they go? Right back to Wall Street. It's a revolving door. The same people who work for Goldman Sachs write the rules at the Treasury. The same people who work for JP Morgan regulate the banks at the Federal Reserve. The same people who crash the economy get hired to fix it. And they fix it in a way that benefits Wall Street. Always. They write the regulations with loopholes. They enforce the rules selectively. They look the other way when their friends commit crimes. And then they go back to Wall Street and get paid millions of dollars for their service. Here's the pattern. Every 10 to 15 years, Wall Street builds up massive leverage, takes insane risks, and crashes the system. Then they get bailed out. Then they lobby to weaken the regulations. Then they build up leverage again, and the cycle repeats. It happened in the 1920s with the stock market boom and the Great Depression. It happened in the 1980s with the savings and loan crisis. It happened in the 1990s with the dot-com bubble and long-term capital management. It happened in 2008 with the housing crisis. And it's happening right now because nothing has changed. The banks are bigger than they were in 2008. They're more leveraged. They're more interconnected. They're taking bigger risks. And they're doing it because they know the Federal Reserve will bail them out. They know the government will protect them. They know the system is designed to privatize profits and socialize losses. When they win, they keep the money. When they lose, you pay the bill. That's the system. That's how it's always worked. And that's how it will keep working until people wake up and demand real change. Now let's talk about the Federal Reserve's secret programs. Because most Americans have no idea how much power the Fed actually has or what they did during the 2008 crisis. The Fed doesn't just set interest rates. They create money out of nothing. When the Fed buys bonds, they don't use existing money. They create new money electronically, type numbers into a computer, and use that money to buy the bonds. I mean, this is called quantitative easing, but it's really just printing money. During the 2008 crisis, the Federal Reserve created $16 trillion in secret loans and bailouts. That number is so large it's hard to comprehend. It's more than the entire U.S. economy. And they did it without congressional approval, without public debate, without transparency. We only found out years later because Congress forced an audit after intense public pressure. And what did the audit reveal? That the Federal Reserve had been lending trillions of dollars to foreign banks, to European banks, to hedge funds, to corporations, not just to American banks, to anyone Wall Street wanted to protect. The Federal Reserve had become the lender of last resort not just for America, but for the entire global financial system. And they did it all in secret. They didn't tell Congress. They didn't tell the president. They didn't tell the American people. They just did it because they could, because nobody can stop them. And who benefited from all that money? Wall Street, because the Fed doesn't give that money to ordinary people. They don't send checks to families struggling to pay their mortgages. They give it to the banks. The banks use it to buy stocks, bonds, and real estate. Asset prices go up. The stock market hits record highs. The rich get richer. The wealth gap gets wider. And everyone else gets inflation. Because when you create trillions of dollars out of thin air, it doesn't just disappear. It flows into the economy. It pushes up the prices of everything. The cost of food goes up. The cost of housing goes up. The cost of energy goes up. Your paycheck doesn't go up, but everything else does. Your savings lose value. But Wall Street makes billions. The top 1% owns most of the stocks. So when the Fed pumps up the stock market, the top 1% gets richer, and you get poorer. That's the system working exactly as designed. Let's talk about insider trading and market manipulation. Because Wall Street doesn't just manipulate the system through leverage and bailouts. They trade on information the public never sees. Insider trading is illegal for ordinary people. If you work at a company and you trade on information before it's public, you go to jail. But for Wall Street in Washington, it's standard practice. Members of Congress trade on insider information all the time. They know which bills are going to pass. They know which industries are going to be regulated. They know which companies are going to get government contracts. And they trade on that information before the public knows. They buy stock in companies that will benefit from legislation. They sell stock in companies that will be hurt. And it's not technically illegal for them. Why? Because Congress exempted themselves from insider trading laws. They passed the Stock Act in 2012 after public outcry, but then quietly gutted it a year later. Now, congressional trading is back to business as usual. Wall Street does the same thing, but on a much larger scale. They have access to order flow data. They know what the big institutional investors are buying and selling before the trades are executed. They see the orders coming in, and they front run them. If they see a massive buy order for a stock, they buy it first, drive up the price, and then sell it to the institutional investor at the higher price. They make money on every trade. It's legal. It's called market making. But it's really just theft. They're skimming pennies off every transaction, and when you do it billions of times a day, those pennies add up to billions of dollars. High-frequency trading firms have taken this to the extreme. They use supercomputers to execute millions of trades per second. They place their servers as close as possible to the stock exchange, sometimes in the same building, to shave milliseconds off their trade times. Because in high-frequency trading, milliseconds matter. Whoever gets the information first wins, and they use that speed advantage to front-run your orders. Here's how it works. You place an order to buy a stock. The high-frequency trading firm sees your order a fraction of a second before it's executed. They buy the stock first, then they sell it to you at a higher price. You lose a few cents per share, they make billions, and it's all legal. Now let's talk about the repo market, because this is the plumbing of the financial system that almost nobody understands, but it's critical. Repo stands for repurchase agreement. It's a way for banks to borrow money overnight by posting collateral. If a bank needs cash at the end of the day to meet its reserve requirements, it sells bonds to another bank and agrees to buy them back the next morning. It's supposed to be low risk, just overnight lending between banks. But the repo market is actually the foundation of the entire shadow banking system. Trillions of dollars flow through the repo market every single day. And in September 2019, it froze. Interest rates in the repo market spiked from 2% to 10% overnight. Banks were refusing to lend to each other. Nobody knows exactly why. The official story is that it was a technical glitch, a shortage of liquidity. But that doesn't make sense. Banks had plenty of money. The real story, the one nobody wants to talk about, is that something broke in the system. Some major institution was in trouble and other banks didn't want to lend to them. The Federal Reserve had to step in and inject hundreds of billions of dollars to keep the repo market functioning. And they've been doing it ever since. The Fed is now permanently propping up the repo market. Without the Fed's intervention, the system would collapse. Think about that. The foundation of the entire financial system is so fragile that it requires constant intervention from the Federal Reserve just to function. Here's the truth about Wall Street. It's not a free market. It's a rigged game. The insiders win. The outsiders lose. And the rules are designed to keep it that way. And when Wall Street makes money, they keep the profits. When they lose money, the taxpayers cover the losses. It's socialism for the rich and capitalism for everyone else. And it's been this way for over a century, because the network that controls Wall Street also controls the government. They write the laws, they appoint the regulators, they fund the politicians, and they own the media that's supposed to hold them accountable. 6 corporations control 90% of the media in America, and they're all owned by the same institutional investors. BlackRock, Vanguard, State Street, the same firms that own Wall Street. So the media doesn't investigate Wall Street. They don't ask the hard questions. They don't expose the corruption. They run the stories Wall Street wants them to run. They push the narratives Wall Street wants pushed, and they ignore everything else. So what should you take from this? First, understand that Wall Street is not your friend. The financial system is not designed to help you build wealth. It's designed to extract wealth from you and transfer it to the top. Every fee you pay, every point of interest, every fluctuation in asset prices, it's all designed to move money from your pocket to theirs. Second, recognize that the Federal Reserve is not a neutral government agency. It's a private cartel that serves the interests of Wall Street banks, and it has more power over your financial future than any elected official. They control the money supply, they control interest rates, they control who gets bailed out and who fails, and they answer to no one. Third, the next crisis is coming. It's not a question of if, it's a question of when. The banks are more leveraged than ever, the derivatives market is bigger than ever, the Federal Reserve has less ammunition than ever, because interest rates are already low and they've already created trillions of dollars. When the next crisis hits, it's going to be worse than 2008, and the bailouts are going to be bigger. Fourth, the people who control this system will never face consequences. They'll get bailed out, they'll get richer, and you'll get the bill. Unless people wake up and demand real change, real accountability, real prosecutions, real reform that actually limits Wall Street's power instead of just pretending to. Fifth, the only way to protect yourself is to understand the game. Don't trust the banks, don't trust the Fed, don't trust Wall Street. Educate yourself, understand how the system really works. Hold real assets, things that can't be printed or manipulated. Diversify outside the system and prepare for what's coming, because it's coming. History shows us that financial empires operate in secrecy because transparency would reveal their power. The Jekyll Island meeting where the Federal Reserve was created was secret. The bailouts in 2008 were negotiated in secret. The Federal Reserve's $16 trillion in loans was secret. Everything about Wall Street at the institutional level is hidden, manipulated, and lied about. And that should tell you something. If the system was fair, if it was designed to serve the public, there would be no reason to hide it. The fact that they work so hard to keep it secret, to keep you confused, to keep you dependent, reveals that the entire system is built on a lie. Because Wall Street isn't about creating wealth, it's about extracting it. It's about control. Control of the economy, control of the government, control of your financial future. And the people who control it will do anything to keep that control. The hidden Wall Street empire is real. It operates through the Federal Reserve, through the big banks, through the revolving door between government and finance. It manipulates markets. It rigs the game. It crashes the economy every decade and gets bailed out. And it does all of this in complete secrecy. You were never meant to understand it. You were meant to trust the system, trust the experts, trust that the people in charge know what they're doing and have your best interests at heart. But history has shown over and over that systems built on fraud always fail. And when they do, the people who see it coming, who understand what's really happening, are the ones who survive. The people who trust the system, who believe the lies, who think it can't happen here, those are the ones who lose everything. The empire is still operating. The same banks that crashed the economy in 2008 are bigger now, more powerful, more leveraged. They've learned nothing except that they can get away with anything. And they're preparing for the next crash. They're building their positions. They're hedging their bets. They're making sure that when it happens, they'll be on the winning side. And you'll be left holding the bag. Unless you wake up. Unless you see the system for what it really is. A rigged game designed to transfer wealth from the many to the few, from you to them. That's the truth they don't want you to know. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.